guys. So as a very episode लिएर यहाँको सामु उपस्थित भएका छौँ. So today what we are going to be learning is ACCA को financial accounting को first chapter, right? So basically यो chapter चाहिँ के को बारेमा छ भन्दाखेरि introduction to financial reporting. So हामीले financial reporting गर्दाखेरि के कस्ता कुराहरूले चाहिँ एक्चुअली फाइनेन्शियल स्टेटमेन्टलाई प्रभाव पार्छ, त्यसपछि गएर त्यसमा कस्तो कस्तो एलिमेन्टहरू हुन्छ, त्यो एलिमेन्टको डेफिनेसन के हो, त्यसपछि त्यसको क्यारेक्टरिस्टिक्सहरू कस्तो हुनुपर्छ, त्यसलाई प्रेजेन्ट गर्दाखेरि रिलेभेन्स, फेथफुल रिप्रेजेन्टेसन जस्ता कन्सेप्चुअल फ्रेमवर्कका एलिमेन्टहरू पनि हामी अवश्य पनि कुरा गर्नेवाला छौँ. सो फर्स्टमा हेरौँ. सो यो च्याप्टरको आउटकम भने हाम्रो के हो भन्दाखेरि हामीले डिफाइन फाइनेन्शियल रिपोर्टिङ गर्न सक्ने भयो फर्स्टमा. सो फाइनेन्शियल रिपोर्टिङ भित्र हाम्रो के पर्छ त, हामी कतिवटा फाइनेन्शियल स्टेटमेन्ट बनाउँछौँ. एउटा स्टेटमेन्ट अफ प्रफिट र लस, एउटा स्टेटमेन्ट अफ फाइनेन्शियल पोजिसन, त्यसपछि गएर हाम्रो क्यास फ्लो, त्यसपछि गएर स्टेटमेन्ट अफ चेन्ज इन इक्विटी. सो आफ्टर द्याट आइडेन्टिफाई एन्ड डिफाइन टाइप्स अफ बिजनेस एन्टिटी लाइक सोल, प्रोप्राइटरसिप, पार्टनरसिप, त्यसपछि जोइन्ट स्टक कम्पनी. त्यसपछि गएर द मेन डिफरेन्स बिट्विन दिज थ्री आर sole proprietorship is owned by a single person and it has unlimited liability. त्यसपछि गएर पार्टनरशिपमा two partners or more than two, but they are not a separate entity and they have unlimited liability but they share it with each other. So profit पनि share हुन्छ, loss पनि share हुन्छ पार्टनरशिपको केसमा. त्यसपछि गएर जोइन्ट स्टक कम्पनीमा भने त it's a limited company where the liability is limited and it is a separate entity. So यो जोइन्ट स्टक कम्पनीले चाहिँ छुट्टै आफ्नो नाममा बिजनेसहरू किन्न सक्छ या फेरि आफ्नो बोकेर एसेटहरू किन्न सक्छ. So that is a legal person. So they will be first. And then after that identify users of financial statements and their information needs. So who are the users of financial statements? Mostly it's like stakeholders, it's the lenders, customers. First would be lenders. So what sort of information do lenders need? Like they need to know like the business is a going concern or not, so that like the money that they have lent isn't gonna be wasted. So that's their primary concern. So next will be suppliers. So suppliers who supplies us on credit, so they want to know about the financial information about the company, because when they are supplying goods, they don't want to write it off as a bad debt at the end of the day. So that's their primary concern, suppliers. After that, you have employees, let's say, internal stakeholder. What are they concerned about? Their job security, whether they'll be in the job for a long time or not. So they would want to look into that, like whether the company is growing or not, and then they might see a future working for that company or not. That's their primary concern. What else? Or like in developing countries, what happens is like before early on, like the employment benefits, like those amounts are how they are actually being invested or how they are being accounted for. Those are also a crucial thing for employees, because it is a major part of their life which they will be living upon after retirement. So that will be a primary concern for them as well. So they want to know about that as well. So that is always accounted for in financial statements. And then after that, fourth number, investors. Most important. Investors, what they want to know about, it's their company, so they want to know about how the company is doing, how the stewardship of the management has been undertaking its performances, so that they can see it in numbers. That's their primary concern. They want to know like, are they getting actual enough return, or is it like just inflated numbers or earnings management? They want to know about that, and then they want to be able to know about the company so well that they want to make decisions about it using that information. They want to look at alternatives as well, like suppose this entity is giving them this much percent of return, this is giving this much percent of return, or like this entity is risky and then this one is not risky, so they want to be observant about different entities. So in that way, they can make their investment decisions. So that's their primary concern. And then after that, identify users of financial statement and their information needs. So identify main purpose of financial statement. So what's the main purpose of financial statement is to provide information. That's the primary purpose. But what sort of information should be provided? There are characteristics to it. So it should be relevant. It should be faithfully represented. So if information is not faithfully represented, what will happen? So that number is not of any use. It's just a made up number. So that will hurt the investors, suppliers, employees, investors, everybody. Whoever is involved within that organization, they will be hurt. And then after that, main purposes. So the information should be relevant as well, because if it's not relevant to that entity, it's of no use again. You can't use that just a piece of number for assuming a return and then not able to get it. So that's not a tangible thing. After that, define elements of financial statements. So what are the elements of financial statements? First is income, expense, and then after that we go to SOFT, assets, liabilities, and then equity. So let's talk about it. So assets, mostly there is three component to assets definition. So what is assets? Assets is one number. Assets is controlled by entity. Or it has control over it. What else? Assets. Economic benefits will flow into the entity as a result of past event. Past event. So this is assets. So what is liabilities? Liabilities is a present obligation. Present obligation. Present obligation. And economic resources will flow out of the entity. Economic resources will flow out. And then, so assets, liabilities is done. So equity. Equity is nothing else than the residual interest. This is assets minus liabilities. So after selling all the assets to whatever money you get, and then after paying out all the liabilities, whatever money remains, that's equity. So let's say, what is income and expense? So these are the 5 elements of financial statements. So let's talk about income. And then expense. A recognition of economic benefits. Of inflow of economic benefits. Expense is same thing, recognition of outflow of economic resource. So this is basically inflow into the company. This is outflow from the company. And then after that, these are the financial statements, elements. And then after that, define and explain accounting concepts and characteristics. So most important thing is characteristics. So what should be is its characteristics fundamentally. What will be its characteristics? So first is fundamental qualities. Let's talk about qualities first of all. Let's talk about frameworks qualities. I haven't discussed it earlier on. So fundamental qualities. So this will be relevance. I did talk about relevance and faithful presentation, but I haven't talked about enhancing qualities. Faithful representation. And then enhancing. Timeliness, understandability, comparability, timeliness, understandability, comparability, verifiability, verifiability, verifiability. Verifiability. So financial statements should be relevant. It should be relevant, and then it should be faithfully represented. Then the enhancing qualities for that will be timeliness, which is like should be from this period, so it could matter, it could differ from jurisdiction to jurisdiction, like because Nepal's reporting date is 31st of Asar 2075 or 76, so it's basically at the end of Asar, whereas UK's may be different, other countries may be different, so it depends upon different jurisdiction. And then understandability should be properly understandable by every user of the financial statement. Comparability, so it should be comparable as well as there should be a comparison with the previous years so that the investor can make well-informed decisions about the entity. And verifiability, so it should be verifiable. The amount that has been reported should be verifiable with a supporting evidence of documents. Suppose you have a sales, so you made a sales and then you get revenue out of it. So what is the supporting document for that revenue? Is your sales register. There is a sales record. So that's another enhancing quality. And then accounting concepts. So what are accounting concepts? Accounting concepts. Is going concern, and then accrual based accounting, cash based. So going concern, what is going concern? It is an entity shall continue in foreseeable future for the next 12 months. That is going concern, that the entity will continue running for foreseeable future, which is 12 months or more. So accrual based accounting system is an accounting system when an expense is recorded as they occur, not when they receive the cash. So that's the main difference between accrual-based accounting system and cash-based accounting system. So suppose you made a sales, right? So you did that sales in credit. So you have to record that sales as sales. So that will be accrual-based accounting. Whereas in cash-based accounting system, when you make a credit sale, you don't record it as a credit sale. You record it only when you receive the cash. So mostly in cases of tax, it is cash-based accounting, and then in our financial accounting is accrual-based accounting. So that's the main difference between these two. So another important thing is materiality. What is materiality? It is when you miss a transaction or when you miss an entry. Suppose the expense was extraordinary. Suppose, let's say, impairment loss. So there was a huge impairment with PPE, so which you didn't record, record in your SOPL. So what will happen? That will influence the decision of investors and other stakeholders. So omission of a record which will influence the decisions of stakeholders is considered material. So it is material. Something of substance. Suppose let's say 1,000, and suppose you miss an expense of 1. That's not material, right? So whereas suppose this is 1,000, and if you deliberately miss the expense of 200, then that is material. So the omission of 200 will influence the decision of investors, because they think like, okay, this is a profitable company, and then when they later on find out that it's a fraud number, then they will be affected. So that's why materiality is important. And then after that, there is substance over form. What is this? It shouldn't be only on the paper. It should actually exist. That's what it means actually. So suppose you have an asset, so just in the name of assets with a legal name, but you don't actually control it. You don't actually no economic benefits will inflow out of it. So into the company. So that's only form, not substance. So in accounting, we actually see substance over form. So it shouldn't be only in paper, it should actually exist. So that's our primary concern when we are accounting for the performance of the company. So this is basically it. So define financial reporting, identify types of business entity, which is sole proprietorship and then partnership, joint stock company. Told you the differences early on. Identify users of financial statements and their information needs. As I said earlier, vendors, suppliers, customers, authorities, different authorities. After that, main purposes of financial statement is to provide information to the users, and then after that, so define the elements of financial statement. Financial statements. So these are income, expenses, assets, liabilities, and then equity. So what is income and expenses? As we talked earlier on, income is anything which is inflow into the entity and it is recorded, that is income. Expense, it is anything which outflows from the entity and the recording of that is expense. So assets, in order to be assets, the assets should, or the entity should have a control over it, and then an economic benefits will flow into the entity as a result of past event. So what is liability? Present obligation, and then after that, economic benefit or economic resource will flow out of the entity, and then after that, equity. So let's talk about assets. What could be assets? PPE, intangible assets. So those are basically assets. Liabilities, it is non-current liabilities, current liabilities. Non-current liabilities could be leases, lease liability, and then current liabilities could be payables, all these things. After that, equity. What is equity? Equity is after selling the business, whatever amount is remained, that is equity. So equity is the residual interest, which is basically assets minus liabilities. After you return fact, whatever is remaining, that is your equity. So that is done as well, element of financial statement, and then define and explain accounting concepts and characteristics. So let's talk about characteristics first of all. Fundamental characteristics should be relevance, paper representation, and then enhancing qualities are timeliness, understandability, verifiability, comparability. So as we talked about, timeliness should be from this period to this period. At the end of the reporting date should be from 1 year. It's usually of a 1 year period. So unless it's an interim report, and then after that, comparability, it should be comparable. So there should be a comparability like between the years or within entities as well. So that is one thing. And then understandability, every user should be able to understand it properly. Verifiability, the information that we've recorded should be verifiable. That is the primary concern. And then after that, verifiability, the other accounting concepts are going concern. So the entity will continue for the foreseeable future, that it will not have any sort of problem. So that's actually given by the auditor at the end of the year when they do the auditing. And then observable accounting is when the sales happen, you actually record it. Whereas in case of cash-based accounting system, what you actually do is you only record it when you receive the cash. That's the main difference between these two. So usually the tax authorities, they use cash-based accounting system, whereas we use accrual-based accounting system, or we can say as financial accounting as well. Or you can, or the profit that you actually get out of this is also known as accounting profit. So materiality, that's also another concept. It is what is material, what is considered material. It is a transaction. If a transaction is omitted or not written down, that will be significant to influence the decision of stakeholders. That is considered material. So 1,000, and suppose you miss the expense. Suppose 1,000 is the income, 1 is expense. Suppose you miss that, that might not be material, whereas 1,200 out of 1,000 is material. So whichever is the use number, that this figure can actually influence the decision of financial statement users. That's why it is considered material. So that's the main definition of it. Substance over form shouldn't only actually exist in paper, it should actually exist as well. So suppose there is an asset, if it's only in the paper and you don't actually have the control over it, and then no economic benefits are likely to inflow into the company, so you can't actually recognize that an asset. So substance over form is pretty important in accounting. So this is pretty much it for chapter 1, Introduction to Financial Reporting. So if you have any other questions, please do comment down below. I'll definitely answer it for you. Until next time, bye bye.